Hello everyone, welcome to another video on our YouTube channel, and today we are going to be talking about something which many YouTube channels don't talk about, and that thing is going to be common mistakes which traders make which cost them a lot of money. You see guys, when a trader is new to the stock market or any other market for that example, he or she is bound to make mistakes and lose a little bit of money. But what happens is that when you commit a mistake while trading, that mistake must not be like you are either losing your whole trading account or you are losing, a part of your life savings and something. So while trading, you are bound to make mistakes as a new beginner. So in order for you to reduce making mistakes, we have made this video in order to educate you about the common mistakes which many beginner traders make which cost them a lot of money. And going on to our video, our first mistake is going to be trading based on FOMO. So what is FOMO? You see guys, FOMO is fear of missing out. Fear of missing out is an emotion. It is basically a human emotion. You see, let's just say that you sit on your trading chair when the market opens in the morning and you see the market rising up pretty fast. And what happens is that you expect the market to come down thinking that this is a false bullish trend. And what happens? You wait for the market to come down. But the market keeps rising, and what happens? The FOMO kicks in on you. The FOMO kicks in on the trader. That trader will be thinking that this is going to be a jackpot trade. He will think that, oh my god, the market is rising so much, hence I need to place a buy order now because this is going to be a jackpot trade or a lifetime trade. Hence what happens? The trader will end up placing a buy order only to see the market, reversing its direction from a bullish trend to a bearish trend. And that trader will be losing money. If not for a stop loss, he may be even, losing his whole account. This is why FOMO needs to be avoided, guys. This is very, very common mistake or a very common emotion between a new or a beginner trader. Now, what many traders do while FOMO is that, they oversize their positions. For example, if commonly a beginner trader takes one lot position during a normal trading day, then the same trader, when the FOMO kicks in, he or she will be taking 5, 6, 7 lots. And what will happen? It will cause a huge lots to them if they are continuously trading based on FOMO. And what will happen? They will end up losing their accounts. So this is something which needs to be avoided. Now, what is the solution for FOMO? Create your own trading plan. Make sure that you confirm the trend in which the market is heading, whether the market is heading in a bullish trend or a bearish trend or a ranging market for that sake. After confirming the trend, try placing your order with the stop loss. And going to our second mistake, that is going to be trading for revenge. Now, what is revenge trading? After a trader takes a trade and he makes a loss in the trade, that emotion will kick in the trader to cover the loss in the same day, and hence what will happen? That trader will take another trade with a bigger lot size which will result in another huge loss. For example, if a trader invests 100 rupees and loses 200 rupees, what will happen? He will get emotional, and what will happen? He will want to cover this 200 rupees loss in the same day. So what will happen? He will place another 500 rupees order and he will end up losing another 1000 rupees for that sake. Now, what is the solution for revenge trading? This is revenge trading, which means he is not trading based on a strategy. He is not trading based on a plan, or he is not trading based on risk management, but he is trading based for the sole purpose of revenge of recovering his or her loss on the same day. Now, going on to the solution for revenge trading. Number one, revenge trading guys, they need to understand that you are bound to make losses as a new trader, and hence try to recover your losses in a slow way instead of getting fast and furious with your trading losses and trading plan. You need to make sure that you are getting your losses in a slow and consistent manner. For example, if a trader loses rupees 1000 in a single day, then that trader, he must be making sure that from the next day, he makes 100 rupees per day, which means if a trader loses 1000 rupees on a single day, then the traders must concentrate on making from the next day that he must make sure that he makes either 100 rupees per day. So if he makes 100 rupees per day consistently for 10 days, then this 1000 rupees loss will be recovered. Instead of doing this, what many traders do is that they jump in and place much bigger lot, which result in many losses. For example, Instead of recovering their losses, they create more losses for themselves. Now a 1,000 rupees loss after getting after trading for revenge, it will be into a 10,000 rupees loss. So this becomes emotional damage for the trader. This becomes a psychological defect for the trader. This is something which many traders do, and we have also given the solution. And number three mistake which many traders do is that gambling and not actually trading. You see, guys, gambling and trading are two different things. Now, I'm not talking about the cards gambling. I'm talking about gambling in trading. What does it mean? Gambling is when you place a trade expecting a high risk, high reward trade without actually knowing anything about the market and expecting the market to move in your favor. For example, guys, a trader is there, and let's just say that he has 1,000 rupees in his account. For example, what will happen? He will place a 500 rupees trade with, in one single trade. He will invest 500 rupees and expect 1,000 or 1,500 or 2,000 rupees in that trade, without actually knowing that the market is actually not in his favor. What will happen? That number one, that trader excuse me, guys. Number one is that trader will not be knowing about the trend in which the market is heading. Number two, that trader will not be knowing even the basics of how the market operates, how the market, is actually psychological more than technical. What happens is that hence that trader, without knowing anything, he will place a high risk, high reward trade and end up losing his whole account. Without knowing anything, he or she will want the market to move in their favor. So this is another thing which many gamblers lose money. I would not call them traders. Traders and gamblers are two different things. In order to be a successful trader, in order to be a decent trader, in order to call yourself a trader, you need to have a consistent plan. A plan for entry, a plan for exit, and a plan for risk management. Without these three, we cannot call ourselves a professional trader. Alright? But if a trader keeps gambling, if a gambler keeps gambling instead of actually trading, then they will end up losing their account very soon, or sometimes even in one single trade they will lose their account. Now the solution for gambling, what is the solution? You see, the solution for gambling is simple. Don't place a high risk, high reward trade. Number one, what many beginners do is that they expect 100 into return, or they expect a 50 into return within a very short period of time. You see, stock market is very profitable, guys. In the long run, stock market is actually very, very profitable if you are staying consistent in your trading. But the thing is that many new traders, they want to become a millionaires quickly, and that is not going to be the case with stock market. Stock market is going to go in a slow and sophisticated manner. You need to make sure that you are staying consistent. Stock markets both consist of both a bullish trend and bearish trend, which means you will be making money in buys and you will be making losses in shorts. You need to make sure that you are staying consistent. Now, what do I mean by consistency? You need to make sure that you are either staying profitable at least 60% of the time, not 80, 100. Forget 80 or 90% of the time. You need to make sure that you are trading, your trading accuracy is 60% of the time. And moving on, the last thing is that they are not having a proper risk management plan. You see, guys, what is a risk management plan? Well, a trader may be knowing how to place an buy order and how to place a sell order. He may be knowing when to take a trade, and he may also be knowing when to close the trade exactly. But the thing is, market doesn't go in our favor always. A market, when you expect a market to go bullish, it will go bearish, and when you expect a market to go bearish, then the market will be going bullish. This is something which even many professional traders face in their trading. But what will happen when the professional trader, he or she loses some money? Then what will happen? They will be losing only a small percentage of their account. It will be like 0.5 or 1% of their account maximum. But the thing is, without a risk management plan, if you are going to trade, now what do I mean by risk management? Risk management in simple terms means stop loss. If you are trading without a stop loss, then you are going to lose your account very soon, right? Now what is a risk management, guys? You see, when you are taking a trade, you need to make sure that you are risking only 1% or 2% of your account. If you have 10,000 rupees in your trading account, you need to make sure that you are taking a trade for only 100 rupees or 200 rupees at the maximum. This is what many professional traders, including myself, follow. No more than 2% of their 2% of our accounts in order to stay safe, right? And placing a stop loss. What do I mean by stop loss? You see, guys, stop loss is something which, let's just say, let us go to our charts now. Let's just say, guys, just look at this. The 20 period moving average crossed over the 50 period moving average, hence you expect the market to go higher. What happens? You place a trade immediately here. You place a buy order here. You expect the market, for example, to go around till here, let's just say, and you see the market is heading in your direction for quite some time. But what will happen if you haven't placed your stop loss expecting the market to go around higher? You will only be end up losing your account like a low and then a low high and then a lower low. What will happen? You would have lost your account probably by here. So, but if the same trader, he or she has stop loss, what will they do is that they will limit their risk either by placing a stop loss at the previous low, which means that they would have lost only a percentage of their account here compared to no loss. I mean, compared to no stop loss of losing your whole accounts here, they would have lost only a small percentage of their account here when the stop loss gets triggered by this candle. So this is how professional traders limit their risk. This is how professional traders actually limit their risk. It's not like, professional traders win 100% of the time. Pro traders actually win only 60 or 70, 80% of the time. Even if they win 60% of the time, let's just say that they made 100 rupees. For example, they made 100 rupees, and what happens in the last, in the last 4 trades, in 10 trades, the trader made 100 rupees. But what happens in the last 4 trades, it went in a loss. Each trade, they lost rupees 10, rupees 10, rupees 10 since the stop loss got triggered. But still, 6 trades are profit, which means the trader is still in a profit of 60 rupees. So this is how professional traders limit their risk. This is why risk management is also very, very important while trading. Without risk management, a trader is a sitting duck, even though he or she knows much about the market. So I hope that, I hope this is enough for today's video. And I hope that, traders will be following what we have said in our video. And make sure you do love, if you love our channel, then please do click the like button, subscribe to our channel, and that will be very much supportive of us. And take care, guys. See you all in the next video.